Greetings, tuition every single individual. Hopefully, all of you guys are doing exceptionally well. So today we'll just be basically focusing on we'll just be focusing on our structure for income statement. So it's financial accounting N6. Let's look at our structure in which we'll be using for this year. So to see where did it change and also what you should know. I'll just be basically looking at the structure and the principles exclusively. Let's start with the first component. The one that you already know is our sales. It's our sales. We know that in our sales, we have to minus our debtors allowance, in which we know that our debtors allowance, our returns, and then it will give you a net sales. And then you have a cost of sales there. Remember that your cost of sales should always be in brackets. Bracket means minus. So when you say your sales minus your cost of sales, you'll have this item in which you call gross profit. You would have your gross profit. And then after that, you have your other incomes. So your other incomes are referring to the likes of rent income, your commission income, and also interest income. So all the incomes, we know that you do not have only three incomes. So a variety of our incomes. So all of the incomes in which we know, maybe finance income, and so forth. So all the incomes in which our business or our company, in fact, company, let me just be clear and concise. Remember that we're dealing with companies. So all the incomes in which your company will earn, you'll record them under your other income. And then when you add them, when you add your rent income, your commission income, your interest income, and all those other incomes in which they were not mentioned here, you'll get this total of what? Of other income. Then let's go to the second component in which we call our expenses. Expenses should be in brackets. The total for your operating expenses should always be in bracket. Bracket means minus. And also with regards to your expenses, you have your expenses such as what? Your bad debts. And then we know with regards to bad debts, we'll always say the bad debt that is in the trial balance plus the one that is in your transaction. There will never be a situation whereby in your bad debts you have to minus. So it's highly impossible for bad debts to minus. You always add in bad debt. And then you get your very initial record date. And also you have your salaries and wages, your interest expense, or your finance cost. You record them there under operating expenses. We know that we have a variety of expenses in which in our situation here we only mention three of them. And then expenses such as your insurance, in which insurance is always assessed. Your insurance, your bad debts, your consumable stores, your stationery, and so forth. You record them under your operating expenses. And then after that, you'll add your expenses, which is bad debts, salaries and wages, and all those that we mentioned. And then you'll get your total for operating expenses. After that, you will say your gross profit plus your what? Plus your other income total. Plus your other income total minus your operating expenses. And therefore, you'll get your profit before tax. You'll get your profit before tax. How do we get it? We get it by seeing our other income. We get it by seeing our gross profit plus other income and also minus our operating expenses. And then we get our profit before tax. And then we introduce what we call income tax. So with regards to companies, our companies pay what you call income tax. So for you to be able to calculate your income tax, normally it's a rate. They'll give you your rate. And then income tax, let me make an example. In most cases, they always use 27% or 20%. Let me make an example. Let's just say after calculating your things, you got your profit before tax as what? As 1 million rand. We're just making a hypothetical transaction. They just say you got 1 million rand. They'll tell you, Kuti, maybe your profit, your income tax is what? Is 28% of what? Of profit before tax. And therefore, we say 28%. Let's say the transaction says your income tax is what? 28% of profit before tax. Therefore, for you to be able to calculate your income tax, you'll use your profit before tax. Therefore, you will say 1 million rand multiplied by 28%, in which when you multiply them, you will get 280,000 rand. And then your 280,000 rand will represent your income tax. So income tax, you'll have to record it in brackets. When you write it, don't remember those brackets. And then after that, you will say profit before tax minus your what? Minus your income tax. And then you get your profit or loss for the period. In the hypothetical example, we would have said 1 million rand minus 280,000 rand, in which you get 720,000 rand. In our example here, 720,000 rand. So always remember that for you to get a profit or loss for the period, you will say your profit before tax minus your income tax. And then you get your profit or loss for the period. And then you also have other comprehensive income. What do you record under our other comprehensive income? We record this item, revaluation surplus. What is a revaluation surplus? So revaluation surplus, so remember that we have our asset. Our asset, we have water, land and building, equipment and vehicles and so forth. So remember that your vehicle and also equipment, they depreciate. Depreciation meaning that they lose value as we're using our assets such as vehicle and also equipment. They depreciate, meaning they lose its value or they deteriorate. They depreciate. But then with regards to our land and building, our land and building does not depreciate, but then rather it appreciates, meaning its value increases as we use it or as time goes by. So we call it land revaluation. That process in which our land and building value increases, we call it land revaluation. So with regards to land revaluation, they will give you a scenario. Maybe they will say that at the commencement of a year or when you bought your land and building, it was valued at 300,000 rand. Maybe they will tell you, good, after 2 years or after a year that you have used it, the value of your land and building right now has become 650,000 rand. Therefore, you can clearly see that the value has appreciated or has increased. So what you will do then, you will check the difference between the two items. So we'll say 650,000 minus 300,000. And then you'll get 350. That 350,000 rand will be the value of our land revaluation or revaluation surplus. That will be our revaluation surplus. So it simply means that our land and building has increased by 350,000 rand. So 350,000 rand, we will therefore record it here as our revaluation surplus. 350 revaluation surplus here. 350 revaluation surplus. And then also write it here as other comprehensive income, 350. And then for you to be able to get your total comprehensive income for the period, you will say profit or loss for the period plus your other comprehensive income. And then you will get your total comprehensive income for the period. So that is your structure in which you'll be using for your income statement. So what's most important is your structure. You should be able to calculate your profit and also your other comprehensive income as they're important. So if ever cannot comprehend with the structure, it's going to be much more difficult for you to be able to write everything. So with that being said, thank you. Hopefully, guys, you'll use this video very, very fruitful. And then remember that this structure in which today or we have dealt with today is too paramount. So we should know it and learn it. Thank you.